Welcome back to That Property Show. For the last 20 years, we've been property investors. The last 15 years, property professionals. Since 2013, we've helped thousands of Australians accelerate their property journeys and make their financial dreams finally become a reality. On this show, we talk issues, news, strategy, do's and don'ts, real stories and interviews, everything property, finance and money related. If that sounds like you, stick around. Welcome back to That Property Show. I'm Richard Waldron.
I'm Ash Waldron. Welcome back.
This is the place where we talk about all things property and finance, and at the moment, it is a changing marketplace.
We've definitely got some interesting topics to discuss, that's for sure.
Now, we've had a lot of inquiry from clients and people that we work with over the years in this interest rate environment that's changing very, very much. People who have existing portfolios, what can they do? How can they expand their portfolio in this market, or when the rates are going up, how's that affecting their cash flow? So we identified a few topics that we thought would be really relevant to that we'll talk about today.
I think probably one of the things we're getting asked a lot at the moment, a lot of phone calls coming in. Obviously on Vest app there, we've got the news articles. We mentioned the minute the RBA made their rate rise decision this week, which probably wasn't a surprise, do you think, Rich, in regards to the way that the RBA was talking about it up until then? It seemed like it was all but a foregone conclusion, no matter what the results were of the day.
Yeah. Look, there's two components. The Reserve Bank's very, very limited in the tools that they have to actually affect the economy. They've got monetary policy by raising or lowering interest rates, and then there's the slang term jawboning, which is where when the Reserve Bank governor comes out and presents the new numbers, they sit down and they'll give a statement while they're doing that and at subsequent events, so they can raise rates and then talk about further rate rises as an effect to try and slow the economy
without actually doing it.
Actually doing it. So not saying that they're not going to be raising rates or what they're going to be doing. Who knows? We never thought we would have seen 10 interest rate rises consecutively in a row. But these are the things we sort of think about. We've heard a number of pundits and things like that come out in the last week raising that jawboning thing, and I think a lot of people are just hoping that that's part of the process that we're seeing at the moment.
I mean, one thing I'm seeing from the RBA rate rise and the race rises that we've had that I find surprising is constantly on the news you talk about the mortgage cliff, which we're going to go into a bit further a little bit later on. But the other one is just that the cost of living, people are saying they're already struggling now, but most of these people that are talking about it are still under a fixed arrangement. So they've either got a couple of months or at best maybe 9 to 10 months before, I guess, really if it's already pinched now with an extra 3% on their loans in some case, it's going to be pretty difficult.
It's a lot of stress for people. People went out and they did the right thing. They borrowed on the recommendations and the information that the Reserve Bank was saying a couple of years ago about how rates won't be touched until 2024. And obviously this puts them in that situation. So the other thing that we're getting into as well at this point, which is important to note, is that there's been some rhetoric which has seemed to have stopped mostly by the Reserve Bank governor. And it was around people's irresponsible borrowing, people who borrowed too much money, that type of thing. The simple reality is, if we go back to February 2022, we look at rates there around, people were getting sub 2% rates. The APRA reinforced that their servicing margin was going to be 3%. And then basically what we saw since then is that now we've increased in excess of that margin that was enforced by APRA for different lenders to be able to lend funds. So, people haven't been irresponsible. They've followed the guidelines, and now they're under stress because we've gone on record rate rises. So, that's sort of the summary of where we are.
So before we get into our other content that we're going to go through, I just touching on what we we're just talking about just then, the buffers. So we are going to go further deep into that, but the cost of living problems and the irresponsible lending is what the RBA governor wants to talk about. A lot of those people, if they were getting sub 2s or even 2%, the bank servicing would have been 5%. They're well and truly above that right now.
Definitely. After this latest rate rise, market-leading rates are going to be in the 5s. I think definitely 4s are gone, and we're into new territory in terms of affordability in terms of what people borrowed on and were lent on in that period of time. And we're looking at people in terms of the rates that they locked in at and everything like that. There is just no way of avoiding it. This is where we are. But there are some things that we can do to minimise that. If you are in that situation, we're going to spend quite a bit of time going over those different strategies today for sure.
Very interesting. Interesting times indeed. Well, let's have a chat. Let's explain to people that maybe perhaps don't know the exact how inflation works or what is inflation, because it gets referred to all the time, about this thing that needs to get under control, the beast that needs to get down to 2%, 3%. Why don't we run through that a little bit?
For a lot of people out there, we go through our day-to-day. We live our lives. We find out once a month that our rates are going up by a letter in the mail from our bank saying, congratulations, this is how much more money we're going to take from you each month. It's never a welcome surprise. But I think people would benefit a lot from knowing exactly where all that comes from. Yeah. Your bank doesn't necessarily set your interest rate. I mean, they do to an extent, but there is a limit on how low they can go. Mm-hmm. And the Reserve Bank is in charge of the monetary policy for Australia. Through when we talk about monetary policy, they are in charge of controlling inflation. And inflation is the growth in price of goods in the economy. So, if milk's $2 this year and $10 next year, we've had a massive amount of inflation in terms of as a percentage. Now, in that case there, from $2 to $10, that would be a 500% inflation rate.
Yep.
Okay? If we're talking of where we are currently, the number that they're putting around for inflation is around about 7. And that's not, it's a bit of an arbitrary number because they do it month on month, and you look at a year in reflection to find out what was the inflation for the year. So you can have quarters that go up, which might be around Christmas time. You can have quarters that go up, around other sort of spending times and times that are leaner. But at the moment, they're saying around about 7. So the next thing is, okay, it's about 7%, not 500 like with the milk. The mandate that's written in the charter for the Reserve Bank of Australia is that they need to be keeping inflation between 2 and 3%. Now that is a good thing because it means prices aren't going up, wages aren't being eroded, because if everything goes up by 100%, you're not going to get 100% wage rise. So effectively, we're poorer when inflation runs quickly. How do they measure it? What is that 2 or 3%, and how is it measured? What they basically do, they measure it by what's called CPI, Consumer Price Index. And what they do is they look at a whole range of things in an economy that a consumer needs to spend money on. So that will be housing, it'll be insurance, it'll be food, certain foods, all different sorts of things. And all of those items are weighted independently. Yeah. However, what we're seeing, they used to change that weighting of everything every so often, 5-10 years, that type of thing. Now there's an annual mandate where that means that if that item goes up in the basket, it potentially may mean more or less of that amount. So when we're at the moment, we've got inflation from 2 forms. We've got prices going up in your groceries, which is normal stuff.
Got electricity moving very fast.
Electricity's moving because of policy. And other areas like insurance, there's been massive increases in insurance, and all homeowners and landlords be well aware of that. Insurance has gone right up. Your car insurance, you get the renewals in this year. It's not, $120 like it might have been last year per month. It's up to $200 in some cases. So all those things are going up.
15% or in some cases, isn't it really?
So you put all of that in a basket, and effectively out comes a number, and that's what the Reserve Bank's looking at specifically when they're trying to bring the economy back in. So that's primary, and all the other things like unemployment, economic activity, all that stuff, that's secondary.
Yep.
So we can, as the unemployment goes up through this cycle, they're going to be still focused on that 2 to 3% of the inflation rate, and that's all that they're going to worry about. So sometimes it can seem certainly like they're not listening and all of those things. It's because their mandate is that. Now, there's arguments these days as to whether it should be 2 to 3, whether it should be 2 to 4, because a lot of the growth in living expense at the moment is through government policy around insurance and around, obviously, electricity prices, energy, that type of thing. Energy's being made more expensive these days, no matter which side of the fence you sit on, by government policies that they've got in place now. So that's sort of how that sort of works in terms of the inflation and how it's measured, which probably makes sense, and we've all probably noticed and seen things change in price. Some things go up and stay up, some things go up and come back down. We all saw that with lettuces a year or so ago, where they went to $11 for a lettuce and they're back down to $2. So, these things, a lot of the supply is coming back normal again. So you probably would see that some of these prices are going to go down, and that inflation will drop back down.
All right. So let's have a look at some of the previous data I've just put up on the screen here, which we'll blow up for you in a second. A lot of people are talking about, or you hear, back in my day or back in the 90s, that interest rates were much, 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 much higher. They saw them go to close to 17%. A lot of people say those figures obviously brought the property market to its knees, and they could get back there. That's what a lot of people are saying. They could go back to 18% and these type of things. Now, we've got 2 charts on there. Just want to explain us there, Richard, what the average loan size was even just 20 years ago.
Yeah, that's right. I mean, one of the things when we talk about, like you said, about the interest rates, people, your parents, grandparents, I remember when they were that high. As a proportion of your income, it didn't mean as much back then. Because if you have a look at the chart on the left-hand side there, talking about the size of a mortgage for a loan there, you can see up to now it's about $600,000. So a lot of our numbers today are going to be based on that number. But if you just go back to 2002,
20 years ago,
which is 20 years ago. Oh, hang on. Doesn't seem like 20 years ago, but it's 20 years ago. If you get back to 2002, you can see it's sub $200,000 is that mortgage size that people had at that time. Now you take that back another...
I believe it was about 80,000 then, roughly.
About 80,000. Now, if you compare that to the household income of that time, if we go back to the 80s in terms of household income from the household to what the mortgage size is, or the value of the home is, you're about 3.5 times your household income was what your house price was.
Yes.
So as a median price. So that if you, let's just say you didn't have to pay tax, you could go to work for 3.5 years, don't eat, and you could pay off your house. Right? That's the reality.
Well, as long as you paid the interest rate, the high
interest
rate.
Yeah, of course, all that sort of stuff. But that was the thing. So you can imagine how that would actually represent a very small part of the family budget in terms of that commitment for that mortgage. Fast forward all the way through to today, after the last growth cycle, now the average home in Sydney is 11 to 13 times the household.
Well, if you've got a medium income there, a medium price of housing at say 1.1, 1.2, and they're earning $100,000. Yeah, that's
right.
Be 10 times
so
their income.
10 times, and I think when you obviously some cities are different and that type of thing. But if you think about major capital cities on the East Coast, that's the environment that we're in today. Where now it's 3 times the amount of proportionately of your of your income. Proportionally. And then the other factor, the compounding factor, and why people are finding it so difficult is when we went to those 17.5% sort of around that range interest rates, they went from around 8 to 17. So that's 2 and a bit times the amount of interest on the commitment that they were already committed
used to. Yeah.
Yeah. This time, people were used to 2%. They had
for a decade.
That's right.
Almost.
Not quite, but they'd done that 2%. That was the maximum they could borrow at 2% with the 3% margin in place. Now we've gone from 2% rates to 4%. That's the double. we're 5 and we're quite quickly going to be at 6%. So that's 3 times. So the home's 3 times more expensive comparative to household income, and the increased expense going up is 3 times as well. So that's how much extra pressure there is on households given everything that's going on. So, believe me, the generations before should have more sympathy for the people that are there today.
Yeah,
it's got nothing to do with avocado toast and that type of thing. But, obviously it's very difficult. But I will say that we're going to go through and we're going to show some things that people can do to make that a little bit easier.
Well, let's have a look at some of the rate rising problems that obviously we've touched on a little bit earlier in this episode. But let's touch on the rate rising problems. So variable rates increasing, it's a pretty big issue for people. The fixed mortgage cliff that is on the news that everyone's talking about, that probably a lot of people listening are in and concerned. And then let's just touch on the mortgage prison, which goes to more talking about, I guess, the buffers that the banks have in place for their servicing and things like that.
Yeah, look, they're the main problems. Hang on, which one are we going for first?
Well, these are the variable rate increases. Yeah.
Sorry.
Yeah.
All good. We're there. All right. So the variable rate increases. How much is it? What does it mean? I'm sure a lot of the people that are out there with getting in these increases, they know how bad this is, what it feels like, or they're starting to notice. I
think a lot of people out there though, they're getting like the notices today, but that's the interest increase that we've had. No, they got another one coming next month.
Yeah, or even 3 behind.
Because the banks are catching up depending on when they pass it on, right? Because they can pass it on straight away, 2 weeks later, 3 weeks later.
Exactly. But if we think about a 0.25% increase and we think about a $600,000 loan, that's that average $600,000 mortgage, that type of thing, that works out to be $91 per month. Okay, on that thing, you think, $91, no big deal, except for the fact that we've had 10 of those.
Yeah. Oh, and some of those,
and some of those were double.
Yeah.
And some of those were double. So you start all of a sudden you start getting over the $1,000 a month in repayments. On the larger mortgage, if you go up to the next level, just on that last slide, you got $1 million loan, which a lot of people.
The average size in Sydney is
it's 100,000 with an extra comma. But if it was $1 million, that'd be $153 per month each time. 10 rises. Some of them were 50 basis points, but it's big numbers.
It's big numbers, definitely big numbers.
So when the rate, what's been happening, I guess, is that, with the rates, they've gone up. We've been doing the increases. We know the Reserve Bank's doing all of this stuff. Where does it stop? Where does it end? There's been a lot of commentary. The big ones that are out there making comments are the economists for each of the different big banks, that lending institutions. Yeah. They're very opinionated on it. They have a very strong opinion one month. The next month they can write a different article and it's different. But look, we're probably, the consensus seems to be we've got far more behind us than we do in front of us. It's probably a general thing. They're not the ones making the decision. The Reserve Bank governor is, and there are a lot of people are talking. I mean, we've heard 4% is where people are thinking that they're going to be.
4.1. That's where it seems to be the talking. My concern is they keep raising them. They're looking for the difference in what we were talking about in an earlier piece about inflation. Yet there's still all this money fixed in at low rates. Listen, I know people aren't silly. They will be paying attention to when that comes out. But maybe they're also thinking, that's 6 months away. Yeah. I'll worry about it closer to 6 months. So this inflationary target that they're aiming for.
Assignment's not due for 2 months.
Yeah.
Assignment's not due next month. Assignment's not due till next week. And all of a sudden you're trying to figure something out the night before. So we're going to cover that. We're going to go over that and explain that in a bit of detail.
So we've got a chart there. Which it doesn't have the latest, it doesn't have the latest view, but it does show for how long the interest rates just stayed stable and extremely low for that period of time before they started, obviously, a steep increase that we saw on the previous chart. Fixed mortgage cliff. We've spoken about this one a little bit. How much? I guess that's what we've got on the screen here. How much of that roughly of the Australian mortgages are fixed? Yeah. And inside this mortgage cliff, how big is it? Is it everyone knows somebody who's fixed their loan, or maybe they are themselves? Are they alone? I don't think so.
Well, I mean, it's certainly this mortgage cliff. So what effectively they refer to the mortgage cliff as, you've secured on a fixed rate. It's a nice low rate. Perhaps you secured your rate in 2022, late 2021, and you were able to secure it, 3 years, 2 years fixed for 2%. Let's just keep the numbers nice and simple. So you're running along on your 2%. Now all of a sudden we're coming up to, let's say, June or July or October or next month, who knows, and you're going to revert from that rate to the current rates. So effectively, your interest component of your loan repayment is going to be 3 times what it was previously.
That's going to affect roughly a quarter of the people who have mortgages in this country.
Yeah. So $2 trillion of mortgages, 25% come out this year.
I think they came up with the figure $380 billion for this year, and then there's some more next year. To come out as well. So they're going to see that massive increase, and with the rate rises that we just had, and if we're going to have another one and see it hit 4%, we're talking about 7%. Could be considered a standard sort of rate someone goes on to. That's something we haven't seen since probably 2010, I wouldn't think. Of bank rates being at about that much for money.
They've been quite a while. And I think when they look at the numbers, this is my personal opinion, when the Reserve Bank's looking at, we've put all these rate rises, we're still seeing inflation. That percentage of people there, that quarter of $1 trillion of lending there, their week-to-week expenses from a mortgage perspective hasn't gone up yet. That's a quarter of the people that have got a mortgage, and they're all going to get the new rate. So during this year, now if the average of those home loans is $600,000, that extra repayment that once they drop out, it's going to be $1,500 a month in extra repayment over the course of the year. That's significant money. That's over $20,000. A lot of those will be home loans, which means they've got to be paying it after tax. So when we fast forward and we think, okay, that money is going to effectively be taken out of the economy, it's going to be taken away from cafes, it's going to be taken away from retail, it's going to be taken away from groceries and swimming lessons and everything else. When we get to that stage, think about the flow-on effect for the economy. What the Reserve Bank wants is coming, but they've been raising, expecting it to happen. But it takes time. It's a big machine to slow this economy down. It's a big thing to change people's spending patterns. They've really got to see their bank balance get low before they'll change. Yeah. But when we fast forward and think to Christmas, you think a quarter of the people with mortgages are going to have an extra 20 grand potentially of mortgage repayments over the course of the year. That's a lot. That does a dent in people's Christmas. It does a dent in lots of stuff. So, there's a big argument that when that comes in, the pressure for rate rises could definitely, that'll be satisfied with the Reserve Bank, and we might be in a different phase for sure.
Yeah. So you touched on some of those numbers. We've got some examples there. So $600,000 loan is going to increase roughly by about $20,000 if they go up to a 7%, and the $1 million mortgage there is going to go up to around $34,000 per annum. A serious increase. I mean, if you think that the people in Sydney there, the average loan size is going to be $800, which is some of the highest in the country. That's a big jump, especially after tax. I mean, you're going to be needing to earn $45,000-$50,000 to even just try and cover that extra than what you already have now. It's more than a second job, right?
Well, for families that let's just put it into perspective. That's after tax money. In a lot of cases, they're just on a $600,000 loan. That's potentially like all of a sudden I've got 2 more kids I have to send to private school this year. And people struggle with private school expenses. Well, you're not getting anything for this money. Really, it doesn't feel like it anyway when you spend it. It goes straight through. But yeah, that $1 million figure. When you're getting to that 30,000, you don't earn $27,900. $34,000 to pay that. You gotta earn 50.
Yeah.
To get that. Yeah. So obviously that mortgage cliff. We've just talked about how obviously that can be devastating. What that's going to affect in the economy and all of those different sorts of things. But why does it jump so much? So if we think about if we're on the loan, the fixed rate of 2%.
A lot of people are. Yeah.
When it pops out, you don't just pop onto the best rate in the market.
So not those advertised rates they're trying to get new customers with?
Those new customer rates, that's not what people go onto. Everyone needs to be aware of that. When you pop out, you're going to pop out potentially, with a couple of rate rises later this year, you might pop onto 7.5, which might be 1% or 1.5% in some cases above what you might be able to get in that market. And so a lot of people, when they're doing this and they're thinking about that cliff, don't ignore it. Start looking at it now. If you need some help with us, contact us, talk to us. We can look at what the options are today.
Yep.
Potentially there might be options for you to refinance today, but there mightn't be when the rates go up a little bit further. And we're going to talk about mortgage prisons shortly.
Yep.
But yeah, that's the thing is be proactive. Make sure that when you do come off, that it is going to be onto a market leading rate with that lender. And there's a bit of effort to go to negotiate that. And
so basically the people that were fixed are going to go on to the worst rate, and the people that are currently in variable, maybe they've been doing some negotiation, those types of things, they might be on slightly better rates, 0.5% better or something like that.
I mean, currently, just anecdotally, some of our clients, contact us that we haven't sort of had contact with for a while, might have been with done their lending through someone else. It's common at the moment, right as today, hearing people that are in sort of the mid-6s, late 6s, and then this is for investment. And then when we negotiate them, we can get them down into the sort of the mid to early 5s. So there's a significant saving there. I mean, that's 4 rate rises, 5 rate rises. And you've basically just gone back, taken out of the equation. So,
we might have a look at that. We've got a slide on that one there. So, potentially saving them $665 a month.
That's a perfect example.
A month. If they're on $1 million loan there, a lot of investment property loans, plenty of them at $600,000. That could save them, potentially by actually just filling out a form and sending it back to you. You could be saving close to $8,000. Now that, to me, I know from the property side of the numbers that could actually make your investment property go back to being sort of, closer to positive cash flow or neutral cash flow instead of costing you thousands because you've just ignored that rate.
100%. 100%. Being prepared for it, negotiating so that rate is achieved. It's huge, and it does make. And it's people say, oh, it's not really worth it. But when you look at the numbers of what can be saved now from what they're popping out on a standard rate to just like a reference rate back onto a competitive sort of market leading rate, huge difference.
And that can be done with your current lender. There's no application.
That's right.
They don't have to look at your income again. You can just can go back in there and basically, I guess, threaten to be going elsewhere, but just waiting for them to lower the rate.
Yeah, that's right. Same lender, nice and easy.
Yeah.
Probably a day or so to put the paperwork together, and then once it's successful, it takes about a week or so for it to be implemented, and then you're on it.
All right. So anybody listening to that out there, just shoot us an email, ring the phone number, click the button on the app, and we'll be happy to help you out with that.
Yeah, very easy, very simple.
So mortgage prison. Let's jump into about that. What that entails. We know we've talked about the mortgage cliff. We've talked about the interest rate rises, those type of things. The mortgage prison, I think people understand in a way what that means, but let's go into a little bit more detail. For some people, it's mortgage prison. For other people, it's unable to get a mortgage. Yeah. A lot of first home buyers, I know it's worse now than what it was before. Even if property prices come down, I can't borrow any money. On the reverse side of things, you've got people who, I guess, they're imprisoned in their mortgage. They can't go anywhere else for a better rate. But let's have a dig into that if you want to.
So the mortgage prison is something that, in Australia we have very portable loans. And we need to be, because we only get short fixed periods. We get longest fixed period you might get generally is 5 years. There's some lenders that might do a little bit longer, but if you compare it to, say, America, you can get 30 years, 40 years, fixed term, 40 year fixed term. So, how good would that have been if we had been able to get that here in Australia at 2%? But we can't, and so often people will their lender won't give them the best deal, and that can be for a number of reasons. The bank's not being competitive in the market. The bank might be under the impression that the client might be stuck with them. There's a big effort a lot of the time, that perceived effort for people about refinancing. I disagree. It's not really not a great hurdle to climb. But unfortunately, what we're seeing at the moment is people who were borrowing at 2%, let's just use that as the example we have, they were tested at 5%. And so they might have done that comfortably. Maybe they could have serviced at 5.5%. And people would say, oh, well, it's 5.5% now. Shouldn't we be able to get the loan? Shouldn't we be able to get all of these things?
I can pay it now. I can pay it now.
But the thing is, now when the rates are 5.5%, let's say, you've got to add 3% to that. So now you're having to service at 8.5%, and that just blows a lot of people out of the water. So, this
more rate rises potentially could be 9.5%. And I think everybody out there knows, with the, like we're talking about earlier, the 10 times their income levels for their property and things, if they were getting serviced, or if the interest rate, if they had to actually pay 9.5% interest rates, I don't think they could.
No,
I don't think they could at the moment. Not the average. Not the average. There are some that can, I'm sure, but I think the average Australian that would. It's already a hurdle now at 5.5%. With the cost of living.
Well, here's a little number. So let's say, for example, we know that the standard household, the house price, the median house price is effectively 10 times what the household income is. If the interest rate, let's say you borrowed all the money to buy your house, if the interest rate is 10%, that's all of your income,
all of your money
to pay the mortgage, no tax paid, no bills, no food.
Yeah.
So that's the reality that we live in today. And I know a lot of people don't borrow all of the money for their house. I understand that. But we were encouraging people, when we say we, as in the government, was encouraging first home buyers to go out and buy.
Into the market, yeah.
Really have to have no skin in the game, no deposit. They can borrow sort of, over 95% in a lot of cases. Well, those people with these rates, that's what we're looking at.
It's a problem. Definitely is a problem. So I guess final thoughts for today.
Final thoughts.
What can people do?
Yeah, what can people do? There's plenty of things that you can do to lessen the effect, to prepare for all of the situations that are coming forward. One of the things that we could go through, there's probably about 8 or 9 things that can really sort of change things. But the ones that you want to look at is obviously negotiating with your current lender. Potentially, you have to do this with a broker or directly with your bank, looking at extending the term of your loan. So if you've got 10 years left, spread the payments over 20 years or 30 years just to make it affordable. That's potentially something that you can do.
So that brings down the monthly amounts that
brings
they're
the
paying.
monthly amount, but it will mean you pay more interest over the course of the loan. But if it means you can pay it and keep it,
it's better than losing it.
Something to look at. Looking at splitting and fixing. If you're not fixed now, maybe splitting some and hedging your bets. That's always something that would have been great to do last year. Yeah. But here we are. The other thing is debt consolidation. Looking at the other loans that you might have, personal loans, and seeing that are on even higher rates again, bringing those down.
And that is something that your broker can help you with. I think also on a combination of that, on the Vest app there, we have got a budgeting tool in there as well. So if you haven't done a budget, and a lot of people just ignore it, and just they may pay their card off monthly without realising how much they're spending on things, definitely, there's no time like the present to start some budgeting there. Do the budget app, see what things you can do without perhaps. It's never a nice thing to have to let go of things that you enjoy doing, but maybe it's a good idea, especially planning for the future.
Yeah, well, that's the big thing. Budget's huge. We're in a tap and go economy now, where everything taps and goes on the phone, on your credit card, on everything. And it's very easy to not know what you're spending. And so a lot of people don't. They just spend until it stops. And unfortunately, going into this environment, we can't do that. And doing that budgeting process, it's gonna sting. It's gonna sting for a lot of people. But it is what we need to do to prepare and obviously to assess options going forward. So anyone that has the app, if you don't have it, get it. It's free. It's every tool that we're talking about is there. It's yours.
Yeah. Just go to vestapp.com.au. Download it there, Google, Android, or iPhone, Apple iPhone. You can jump on it there, or tablet. You can put it on your tablet. You can use it on your computer. And
everything that we're talking about here, you can go back over it. It's all broken up into pieces, so you can. I didn't understand that part or that part. It's all there, more explained and everything like that. So,
and there is no cost.
Yeah,
free.
That's right. It's free. Obviously. That's free. So so that's basically the summary. Don't ignore it. If you want some help to look at it, we can do it. Reach out, get started early on it, have a plan, and you'll do it with ease.
All right, that's it from us here at That Property Show today. We will be back next week for another episode, another topic. We'll raise some other issues and topics to talk about, but hope you've enjoyed it, and we'll see you next week.
Thanks for watching.